The markets ended higher today. They ended higher for the week. The S&P 500 up about 12%. But that pales in comparison to the move on some of these retail names that have been beaten up. The numbers I gave you before the break, 72% gain this week, 63% gain this week, 51 for Dick's. Look at that. Kohl's, 73% gain in 4 trading days. Macy's up 36%. Tim Seymour, I know that makes some investors in these stocks who've been suffering and struggling happy. I get that. That's good. But is there any way to make sense of these moves at all?
Well, when we're talking about Macy's, again, it's at some level, it's certainly with some of the other department stores, but Macy's particularly, it's a covenants review. You have to make some assessments about same-store sales, and the things that we're not going to know are what the ever-important holiday season looks like for Macy's as we get into the fourth quarter, as we come out of all this, but or going deeper into this. But I think the assessment on Macy's has been a credit story and a balance sheet story. Same-store sales, again, will probably be down close to 15% this year. J.P. Morgan just downgraded their EPS to 31 cents, down 31 cents a share. It's throwing darts right now for a company that was beleaguered coming into this. But again, this was priced as if they were going out of business, and I don't think that that's the case. I think there's also very real assets there.
Yeah, and Karen, the equity may be having a conversation, but it appears that the bonds are screaming something else.
Yes, I think that's right. And I always think the credit markets are smarter than the equity markets. And if you look at Macy's, there's a bond. I think we have a chart of it. This is paper that comes due in 2023, so not quite 3 years from now, and it's trading at 70. It hardly bounced at all, certainly nothing remotely close to the bounce in the equity. And something trading at a high teens yield, this is telling you there are very real concerns about Macy's as an ongoing business. Maybe it survives, but I mean, in the dash for trash, I just think it's too risky. Sure, you could have a giant run up like we had in the last week. But I would much rather be in an equity, a retailer like a Target whose bonds trade at par or north of par. It's not going to be up 36% in a week, but it's not, on the watch list for is it going to survive either. So that would be my way to play the retail space.
All right, let's talk now about a similarly beaten up space for a similar reason, and that is concern about consumer. Of course, Steve Grasso, listen, the cruise lines, they've been hit for a number of reasons. I mean, it's a consumer story, but of course they had these horrific headlines as well related to coronavirus on cruise ships. Been hit hard, but look at these week-to-date performers showing our audience. Royal Caribbean up 65%. Carnival, the casinos, win. We'll get to that with Guy in a second. I mean, Carnival's selling what? A debt at 12% this week. Hardly a vote of confidence, although the deal did get done. Any reason to take a chance with some of these cruise line stocks?
Yeah, I think there's a reason to take a chance, but behavior has changed. Even before coronavirus, Brian, these were hit with a wall of worry always. There's always capacity issues with them, how many ships, they overbuild ships. Then when you have the flu outbreak, no one wants to get on a ship. Forget about that. Now times that by 10. I think you're looking at maybe possible bailouts for these companies. That's number one. Number two, Nomura put out a piece yesterday, I believe, saying that they can survive near zero sales until Q1 2021. That takes a lot of the ambiguity and dark zone off the desk for at least the immediate future. So you can dabble here. Yeah. I think out 3 years is what Nomura says. And they also say, go with the best brand. So these are down basically 70 to 80% year to date. Stick with Royal, stick with Norwegian. I'd stay away from CCL, Carnival.
Okay, stick with Royal, stick with Norwegian. Guy Adami, I mean, I don't know if you know anybody that goes on cruises, but you think about people, a lot of people may go on cruises to gamble. Maybe they want to stay away from cruises, but they still want to gamble. Maybe there's a long-term bullish case to be made for the casino companies.
Yeah, and we talked about casinos a couple weeks ago. We said if you're looking for, we remember talking about saying, look, there's some signs of life here, some green shoots, and it might be coming in the form of casinos. And Wynn went down to 43, if you recall, rallied back to 75, came back off. Now it's a $70 stock. I mean, I'm not saying it's going back to 100 anytime soon, and I think you trade these things. But the fact that these casinos seem to be getting their footing is encouraging. I think you trade them still. I think if Wynn were to get back to 75, if you're in the name, you take profits and look for the next leg lower. But at least you're seeing some glimmers of hope in some of these casino names, and I think that's somewhat encouraging, Brian, for sure.